Let's talk about Employee Stock Purchase Plan, or ESPP for short. We'll discuss how to evaluate your company's ESPP to decide if it makes sense for you to invest in, and also what happens come tax time after you've sold some of your shares that you've purchased through the ESPP. You might be wondering, how does an ESPP work? An ESPP lets you purchase company stock at a discounted rate. This will usually be somewhere between 5 to 15% off. For example, if your company stock was at $100, you get a 15% discount, you'd be able to buy the stock at $85. This would give you a profit of $15 if you're able to sell right away. If you hold on to the stock, the price can fluctuate and the profit can grow or shrink. To participate, you can enroll and choose a percentage of your pay to contribute during the offering period. Most companies will have a limit on the percentage you can contribute. There's also a limit set by the IRS of $25,000, but the company limit will most likely keep you under that amount. Your contributions will automatically be deducted from your payroll check and placed in a company account over the offering period. Let's say in this case, the offering period was 6 months. At the end of that 6-month offering period, all the money that had accumulated in the account will automatically be used to buy your stocks at the discounted rate. Each company will have their own set of rules on how their ESPP works. Here are some common things to look for when deciding if you want to participate. You want to find out if you're allowed to sell your stocks as soon as they are purchased. If this is the case, you're almost guaranteed to make a profit because you will buy the shares at a discount and can sell them right away. If there isn't a waiting period, then I don't see any reason not to participate, unless you can't live without the money during the offering period. If there is a waiting period before you can sell them, it becomes a little more risky since you don't know for certain if the market will go up or down. In this case, you'll want to do a little more research on your company's stock and see if that is a risk you want to take. Another thing to look for is called a look back feature. This will generally look at the stock price the first and last day of the offering period, and then whichever price is lower, you will buy stock at the lower price and receive a discount on top of that. So let's say your company stock is $100 on day one and $110 on the last day of the offering period. If your company was offering 15% discount, you'll be buying the stock at 15% off the $100, which would be $85. And then it would immediately be worth $110, which is a gain of $25 per share. Look back periods have the potential for some truly great gains on your ESPP if your company stock performs well in the offer period. How are taxes handled? Taxes can be a little confusing, and depending on how your ESPP is structured, can change how you get taxed. When you sell, you will need to take a close look at your 1099 form you receive from the brokerage, as well as any supplemental information which can be included with your 1099 or might be a separate form. Your cost basis may be different on these two forms due to the fact you receive a discount on your stocks. And that discount is taxed as ordinary income and is reported on your W-2. If you don't look at the supplemental information, you may end up using the wrong cost basis and paying more in taxes than you need to. I'm not a tax professional, and tax laws can change, so make sure that you contact a tax professional if you sell shares of your ESPP and have questions. In the end, if your company offers an ESPP and has no restrictions at all on when you can sell after the purchase date, I believe it's a no-brainer and can be a great way to get some free money since you can sell immediately for a profit. If there are restrictions on when you can sell, then you'll have to decide if holding your company's stock for the required amount of time is worth the risk to you. If you do participate in your company's ESPP, just make sure you stay diversified and don't let your company's stock become a large portion of your portfolio. The last thing you want to have happen is to have the majority of your wealth in the company that you work for. Because if something happens to your company, your portfolio could take a massive hit and you could be out of a job. That is all for today. I hope you all have a great day. Stay diversified and I'll see you next time.